Hi everybody, and welcome to this afternoon's event. So good afternoon Eddie, Lisa and Gavin. Thank you for talking to us today about this very important subject. But before we start, let's do some quick introductions from the panel for everybody that's tuned in. So if I start with myself, so my name is Philippa Batting and I'm the Managing Director of Buckinghamshire Business First. We are an organisation that supports the 34,000 businesses in Buckinghamshire to be part of a thriving, cohesive business community, and really pleased to be the quizmaster today on a subject that is very close to the hearts of many businesses. Eddie, would you like to tell us about yourself?
Yes, indeed. Well, good afternoon to everybody. Hope you will find this panel session useful. I'm Eddie Harrington, Tax Director at Seymour Taylor. I've been here the best part of 32 years now. I have many clients that are required to complete and file a tax return, so it's probably no great surprise that income tax and capital gains tax, two of the areas where I get a lot of exposure. Also get involved in inheritance tax, and because I act for a number of small businesses, corporation tax also comes across my radar.
Thanks, Eddie. Lisa.
Afternoon, everybody. So my name's Lisa. I'm an Associate Director at Seymour Taylor. I have been with Seymour Taylor now for 15 years, so not quite as long as Eddie, but still a good amount of time. I have a mixed portfolio of clients, but I specialise in corporation tax, including capital allowances claims, research and development, and anything else which comes under a corporate tax banner.
Thank you. And Gavin.
Good afternoon, everybody. My name is Gavin and I'm a client manager here at Seymour Taylor. In fact, Lisa's client manager. My specialism is like Lisa's within corporate taxes. However, I'm also involved in personal tax returns and work alongside Eddie at different times of the year. I've only been here for 7 years.
Baby. Right, so our event today is looking at topics that actually came up in the report released earlier this year. So it was a report by the House of Commons Treasury Select Committee called Tax After Coronavirus. And it called for some landmark changes to the UK's tax system to deal with the impact of COVID-19. It's an 80-page long document, so any summarising of it is always useful. It's packed with recommendations for the government to consider, and it's been put together and agreed by a cross-party group of MPs, which looked at how the nation could increase tax revenues without stunting economic growth. So following today's initial session, the panel will be happy to answer any questions you may have. So as we go along, if you want to pop them in the Q&A box, and we'll come back to them at the end. So before we go into the panel session proper, I thought it might be a good idea just to take a step back and perhaps look a little at what has happened since the pandemic began. So Eddie, the last year has been particularly challenging for many businesses, and a lot of them have used furlough or SEISS. What would your reflections be on the year and the impact that there's been on businesses?
Well, strange times indeed, Philippa. We've had a number of support measures that have been introduced, quite impressively, on many occasions because of the very limited time available to get them in place. I don't think any of us would have envied anybody who's had to work on putting such measures in place starting from scratch. You mentioned the furlough and the SEISS, which is the Self-Employed Income Support Scheme. I think they're two of the best known measures that have been put into place. But naturally, these have come at a huge cost to us, which is why we're here today, really, to look to see what the government might do to start repaying that cost, obviously over very many years. I think it's also fair to say that there has been quite a lot of complexity surrounding some of the calculations and the claims, and it's now clear that HMRC are taking a little bit of extra time to reflect on those. I think that anybody who's made an innocent mistake and got something wrong because it wasn't perhaps as clear as it might be, I don't think there's going to be any issues with HMRC in tidying that up. But unfortunately, many of us have seen in the press that there have been cases that have been widely reported where some advantage and abuse has been identified within these schemes. And I think in those scenarios, we can expect the full might of the revenue coming down in those cases, Philippa.
Lisa, are there any issues that you can see coming up in the months ahead?
So I think probably the main issues are going to be, it's businesses and for individuals, is going to be around the fact that a lot of businesses are behind in paying their taxes because of some of the support measures that were in play, and also, their loan repayments as well with the C bills and the B bills that were introduced. So I think once the support starts being withdrawn for those and for the furlough schemes, I think businesses getting back up on their own 2 feet without that support, I think is going to be quite a big issue and a difficulty for a lot of businesses, and getting themselves back into a settled position. So I think they're probably going to be the main challenges. It's going to be cash flow and managing the business over the next, probably year, if we're honest.
Thank you both. So let's move on with the session proper. First question, and Eddie, if you're okay, could you take this one? So yeah. What tax changes or rises do you expect to see in the coming years?
We've got a big hole to fill here, over £325 billion. That's a lot of money to find. We had a budget in March, and I think many of us were expecting to see some changes in that budget. We did have a couple in connection with corporation tax and some increases from 2023 under a new tapered system. The Chancellor also chose to freeze personal tax allowances through to 2026. However, he also announced some new tax reliefs, primarily the super deduction and also the ability to carry back loss reliefs for a further period of time, both of which were designed to help businesses recover coming out of the pandemic. I think highlighting these two different scenarios really does demonstrate how difficult it is for the government to try and get this right. Of course, if you tax a business too much and restrict its growth and recovery, that's not going to be good for business. But then on the other side of the coin, the public finances, which we're looking at, will suffer, and the country will need to service greater debts. It's a very difficult balancing act to get right. The government also has its own political future to be concerned about. And in that respect, it may prefer to perhaps stick with some easier targets. Historically, landlords and investors have been such easier targets, and maybe that trend will continue with this government, and former governments as well have targeted those kind of areas. I think it's worth saying that on the wider international stage, the OECD recently signed a new corporate tax agreement, which will introduce a minimum tax rate of 15%. This has been signed up to by more than 130 countries, including the UK. I think the significance of this, Philippa, is that it should help with the offshoring of profits. I think most people will be aware, and they've read of the ability of larger organisations to perhaps shelter profits in lower tax jurisdictions. So I think this is something that will help target that.
Thank you. What do we think the report tells us about the future direction of taxation? Gavin, would you be all right to take that one?
Of course, thank you, Philippa. The original suggestion from the House of Commons Treasury Select Committee was quite far-reaching and included several areas. The first of which was income tax, i.e. the tax from working. There have been previously several calls to reform this old, complex system, and with it the interaction of different taxes, including a better alignment between national insurance thresholds and income tax thresholds. Secondly, as Eddie has just alluded to, there have been calls to reduce some of the tax advantages of operating either as a self-employed or through your own limited company. As most people are aware, you can extract funds from a company at a lower rate of tax without national insurance contributions, or as a sole trader, pay national insurance at a lower rate. As we continue to move into the digital environment, where the information about our earnings or profits are more readily available, the committee has noted that more work is needed in this area, and it should be monitored in order to see the impact of the current levy on businesses and tax collection for those businesses who are reporting digitally under Making Tax Digital. The committee also suggested that capital gains tax and inheritance tax is an area worth pursuing on the basis that any significant increases in tax could damage future investment in the UK, particularly in light of the recent changes following Brexit. Reference was also made to retail sales tax. However, the committee have stated that there is not enough evidence to support a retail tax as an alternative to VAT, and it could potentially be very complex given the current trade deals and how other jurisdictions would still be able to charge VAT. So finally, in respect of stamp duty land tax, they described it as being economically inefficient and damaging to the economy and should be treated as a priority area for review so that the government could set levels in particular to encourage home ownership and also stimulate home ownership for those buying their first homes. The underlying focus of their recommendations was to attempt to recover the cost of COVID-19 as quickly as possible without damaging business, whilst making it clear that for the time being, a wholesale reform of the tax system is unlikely. But it did confirm that the measures introduced in the budget in March were sufficient for the time being. We do, however, expect measures in future budgets once we have a clearer picture of the nation's recovery to focus on how public finances can be recovered quicker.
Lisa, in what ways can business owners prepare themselves for the upcoming changes to corporation tax?
So in terms of the changes to the corporation tax, so they're coming in from 2023, so we're a couple of years away at this point in time. They are going to be affecting very profitable businesses more than they will smaller size businesses, just due to the way that corporation tax is calculated. So for businesses which have got a profitable business which has got a taxable profit of more than £50,000, they are going to be affected. So what will happen is if you have got profits of over £250,000, you'll be paying tax at the new 25% rate. However, if you've got profits between £50,000 and £250,000, you will pay a proportion of between 19 and 25%, and you will receive marginal rate relief to get yourself into that position. So the marginal relief fraction has been set at 3/200ths. And this is the amount of relief that's going to be obtained by the businesses in place. So I've done a very quick example, which is on the next slide. So if on this business you have got profits of £100,000, what you would do is you would calculate your tax liability at the higher rate of 25%. You then obtain relief based on the 3/200ths of the difference between the £250,000 being the higher rate threshold, less the amount of profits you've had, the 100,000, which gives you your £2,250 relief. What that means then is you've got a liability of £22,750, which gives you an effective corporation tax rate of 22.75%. So it creeps its way upwards between £50,000 and £250,000 worth of profits to get yourself up to the 25% rate. So what this means for businesses is that they're going to have to be very careful in their planning going forwards, and certainly on their cash flow forecasting. This is not something they can put aside for a couple of years and not think about. They need to be aware now because a 6% increase is significant for businesses to be aware of. So looking at this example here, at the moment they'll be paying £19,000 worth of tax, whereas in a couple of years they'll be paying almost 23,000. So they need to know. What obviously they can do going forward as a way to mitigate this is potentially they look at reinvesting some of the the income and profits that they've made as a way of reducing down the taxable profits, so they're not paying as much tax going forwards. Philippa, I think you're on mute now.
I'm on mute. See, there I am trying to save the sound. So with all with all those changes afoot, or possibly afoot, Eddie, should sole traders or ordinary partnerships and other unincorporated businesses think twice about incorporating as a consequence of these possible changes?
I think it's worth stressing at the outset that the changes that Lisa talked through there will only impact a small number of businesses, to the extent that the government are saying that most companies will continue to pay corporation tax at a rate close to, or if not the 19% that they're currently paying at. So it's only the more profitable companies that will be paying a lot more tax. I think it's also worth saying that on the question of incorporation, it isn't just about tax. There are so many other important aspects as to whether a business should incorporate that go beyond tax. I often come out with the phrase to clients when I'm talking about such things as don't let the tax tail wag the commercial dog. And I think you probably all understand, sorry, you all understand what I mean by that. In terms of my advice going forward, I don't think it will be any different to the advice I would have given 18 months ago, 2 years ago. And that is, it's always best to seek advice before you decide to incorporate, and then you can go through all the pros and cons, tax and non-tax related pros and cons.
Thank you, Eddie. What impact will the freeze have on personal taxes? Gavin, do you want to take that one? Are you there, Gavin? No? Do one of the other panelists want to take that one, or shall we wait for Gavin to come back?
Philippa, can you hear me now?
I can.
Oh,
yes.
Brilliant. Sorry about that. I've just moved to another room and turned my video off in the hope that the extra bandwidth might help. So apologies.
No, you're sounding better.
Excellent. Under the government's decision, all personal tax allowances will remain frozen between 2022 and 26. Several personal allowances increased in the current 21-22 tax year, including the personal allowance and the annual exemption, but these will remain frozen for the next 4 years. As I alluded to earlier, this does mean that during a period of inflation, potentially when prices are increasing, the real value of personal tax allowances is actually decreasing, resulting in a lot of people potentially taking home a lower amount of net pay. Income tax is one area where allowances did in fact increase in April 21, and that increase was in line with the CPI before being frozen alongside national insurance contributions. The personal allowance for the 21-22 tax year increased from £12,500 to £12,570, and the income tax higher rate threshold increased from £50,000 to £50,270, and will remain at that level at least until April 2026. It does mean that for most taxpayers, they will see an incremental increase in the amount of tax that they do pay, and therefore a reduction in the amount of net pay, but the increase in the amount of tax could be determined by an increase in earnings and also reduced through some proactive tax planning advice. When it comes to items like pensions, the pension lifetime allowance will now remain at its current level of £1,073,100 until April 2026, as will the £40,000 annual pension allowance. However, this change will make it difficult for some taxpayers to benefit from making tax-free pension contributions to their pension pot in order to reduce their annual tax bill, whilst in the long term it could affect their retirement plans by reducing the amount they can save without incurring an additional charge. In terms of capital gains tax, the annual exemption or annual exempt amount will remain at £12,300. And that's the same for individuals, personal representatives, as well as some trusts. This will therefore reduce taxpayers' ability to dispose of assets without incurring capital gains tax, again, affecting a person's plans for later on in life. From an inheritance tax perspective, the main and residence nil rate bands will also not change, remaining at the current levels of £325,000 per person for the nil rate band, the main nil rate band, and £175,000 for the residence nil rate band until again 2026. In addition to that, we've seen that the residence nil rate band taper will also continue to start at £2 million. So potentially for taxpayers in the local surrounding area, where house prices are around that kind of figure, we could see that becoming more pertinent. Importantly, though, these changes may initially seem insignificant, but when you consider the accumulated loss of tax savings together with incremental changes to the personal allowance and factoring in inflation, it's clear that by 2026, many of us could be paying much more tax, including those workers on lower pay who may in fact actually be taxed for the first time. With this in mind, it is important to note that taxpayers should take suitable steps now to ensure their finances are tax efficient for the future. Thank you, Philippa.
Thanks. So the 2021 Finance Bill was published recently. What impact could this have on the future plans of businesses in regards to taxation? Lisa.
Unmuted. So I think we've already touched on a few of the aspects within there, such as the corporation tax rise and the freezes on personal taxes. There were a couple of other matters in there which were very important to businesses and to individuals as well, which are in relation to the super deduction and the carryback of losses. So I think those two and specifically need a bit more of a discussion point. So in relation to the super deduction, it was launched earlier this year, and it's a new additional tax relief that has been brought out. The idea of it specifically is for businesses to invest more heavily in plant and machinery allowances and in their businesses more generally. So the way that this works is that it has become available from the 1st of April this year, and it will remain in place until the 31st of March 2023. And it offers businesses an incentive to invest in improvements to their businesses, with the idea that it will aid in the recovery following sort of the coronavirus measures that were brought in place. So using the super deduction, a company which has invested in plant and machinery, the super deduction will allow a relief of 130% for items that would ordinarily qualify for the main rate writing down allowances at 18%. So this covers things such as office equipment, so your tables, desks, chairs, also things like electric vehicle charging points, and also things like computer equipment and servers. There's then also a first year allowance of 50% for special rate pool items. So what these items are items that normally would have things like a long life, or they're improvements to the integral features of a building. So those sorts of items would normally qualify for 6% relief. So an increase up to 50% is obviously it's a big step up for most businesses. So in order to qualify for the relief and to benefit from it, the assets being purchased must be brand new. So they can't be secondhand, they can't be refurbished. So that's one of the big issues in there. It's also only available to limited companies. So this is not something which is available to unincorporated partnerships, sole traders, or anything like that. But they will still be able to continue with the annual investment allowance. So using the annual investment allowance, partnerships, sole traders can qualify for £1 million worth of relief on their plant and machinery additions or special rate pool additions during the year. So it's unlikely that they'll be significantly losing out. Obviously, they won't get the additional percentage, but it won't be the idea is that it won't be massive for them. So for most businesses, if they're looking to invest, now's really the time to start doing it. And you want to make sure you've got those costs incurred before the end of March 2023. The other big change which has been brought out is an extension to the carryback loss regime. So ordinarily, you would only be allowed to carry back losses for 1 year. This has now been extended. So for the next 2 years, you can carry back 3 years. So it's slightly weird on the way they've calculated it. So the losses which you are carrying back, the requirement is that you've got to offset them against the most recent years first, before you can carry back further, but obviously you can still carry back 3 years as necessary. So under these rules, what that means is obviously because you're carrying back for an extended period, most businesses, if they had profits during those periods, they've paid that tax liability already. So because they've paid that tax liability, they can now get that tax cash back to the business, which obviously during current times is very worthwhile for businesses to be considering. So this is a temporary extension. So it's in for the next couple of years. There is a threshold on it, so you can only carry back up to £2 million per year, which when you're looking at that 2 million, if you're in a group position, that is 2 million across the entire group. It's not on a per company basis. The only other things just to mention on that is because of the cap, it does mean that the amount of relief potentially obtainable is capped, but it's still £2 million worth of losses. When you're looking at groups as well, if you have losses in excess of £200,000, then you need to apportion £2 million cap. But this is something that we would be looking into, so nothing for clients to worry about necessarily. The maximum cash flow benefit from doing this works out based on current tax rates is £760,000 worth of cash that a business could get back. So that's the £2 million at 19%. So it's a very worthwhile exercise having a look into this when the time comes due.
Yeah, it's a significant value, isn't it? We know there are ongoing debates about merging or aligning national insurance and income tax, and a wider debate about reducing the complexity of taxation. What should taxpayers be aware of in this area? Eddie, could you take that one?
Yes, certainly, Philippa. The government, I think it's fair to say they're well aware that the current non-alignment between income tax and national insurance does give rise to complexities. And I think it's worth saying that, let's be clear about this. National insurance is a tax. It doesn't have tax in the title, but it's just as much a tax as income tax. In the past, governments have looked at trying to align them from time to time. As recent as 2016, the Office of Tax Simplification carried out a review. They concluded that, as with any change of this significance, there would be winners and losers. And before the government should proceed to look at this further, that they really needed to closely examine all those kind of situations. It's a very difficult one to square off, if I'm honest. I also think that the government's priority at this point in time is supporting businesses and workers and helping them through and to recover from the pandemic. So I wouldn't anticipate there'd be too much on this in the short term, but who knows? It is also fair to say that the government has introduced a number of measures in other areas that have perhaps worked towards a levelling up of the tax regime. I can give you a couple of examples. The reduction of the dividend allowance in 2018, it was reduced from 5,000 to 2,000. So I think that helped a little bit of levelling up to those that were typically running businesses through their own companies and extracting dividends, as opposed to perhaps salary out of the company. On a similar note, the government have targeted the off-payroll working rules. Some of you might understand that a little bit better as IR35. There were changes in 2017 that impacted on the public sector, and all other sectors from 2021. But basically, IR35, which was actually introduced in legislation by Gordon Brown many, many years ago, was in effect a tax that was designed to ensure that individuals who were working through their own personal service company would pay broadly the same amount of income tax and national insurance as those that were directly employed, if it was perceived to be that those individuals through their own company would be an employee in the ordinary sense. But as I say, Philippa, we've seen a lot of levelling up on that in recent years.
Gavin, how can taxpayers ensure that tax planning is an ongoing process that takes account of all these changing tax rules and their changes in their personal circumstances?
Thank you, Philippa. So it's important to note that when the government announces any such updates, that taxpayers should keep abreast of the latest news, especially proposals within, say, upcoming budgets and tax consultations that we've seen here. I mean, if any of the viewers like, please do contact Suzanne, and she will happily allow you to subscribe to our free monthly newsletter, where we often summarize such updates. Sometimes it is also hard to separate the rumor from reality, which creates unnecessary uncertainty. However, one thing that we found is that by having potentially a quarterly or biannual or even an annual tax planning session with one of our tax advisors here is the best way to ensure that you and your plans remain tax efficient. It's one of those things where it's very different to go about doing something reactively to being proactive in the first place, and often very difficult to unwind something that is a problem in the future that could have so easily been rectified 3 or 4 years ago when you first went about about making that change. Additionally, a lifetime event could be an important time. So for example, the birth of a child could mean updating your will, in which case you might need to contact a solicitor, tax planning through your accountant, and obviously potential other benefits through an IFA. So for example, you might want life insurance policies or something like that. It's not something that is easy to go back and correct, as I mentioned earlier. And so being proactive now is vital to any efficient tax planning. Obviously, if you do have any concerns about a particular change, then please don't hesitate to contact us.
Lisa, are we likely to see more digitalisation of the tax system in the coming years?
The simple answer is yes to that one. So the government is continuing to forge ahead with their plans at the moment of making everybody tax digital. So making tax digital obviously was introduced a couple of years ago for VAT purposes. That's so far has only been for businesses who are over the VAT registration threshold of £85,000. From next year, it is every business which is VAT registered is going to have to apply the MTD rules. So that's step number one from the government's perspective. The next big step within there is then moving on to making tax digital for income tax. So the plan with that at this point in time, anyway, from the revenue, is that will be effective from April 2023. So this will affect certain individuals who run businesses who have a combined gross income of over £10,000. But it only affects certain sources that they're obtaining that from. So the £10,000 would be coming from self-employment, partnerships, a UK property business, or an overseas property business. And obviously this is likely to change going forwards and might bring in further sources of income, but for now, they're the main sources of income that will result in an individual having to complete, we believe, quarterly making tax digital submissions. Going on from there, they will then be moving on to corporation tax, will be hopefully the final step, but we don't know just yet. So the idea is that will be from April 2026, we'll be making tax digital for corporation tax. So at this point in time, we're in the sort of consultation phase with the idea that pilots will be starting probably some point in 2024, but after we've got through income tax and got everybody onto VAT.
Thank you. Gavin, how is the next stage likely to affect taxpayers, and what can they do to prepare?
Thank you, Philippa. So MTD itself represents one of the largest and most significant changes to the UK tax system, probably since the introduction of self-assessment in 1996. The scheme itself means, as Lisa mentioned there, that affected taxpayers will need to keep digital business records in terms of income and expenditure, including their earnings from self-employment and property income. They must then use MTD compliant software to send updates to HMRC every quarter. This will mean that there will now effectively be 5 tax updates a year sent to the tax authorities instead of what is usually just 1 submission, hopefully before the end of January. The deadline for making the quarterly submissions is 1 month following the end of the quarter, and so not too dissimilar from the current rules for VAT returns. At the end of the tax year, there will then be a final declaration made to HMRC to include all other sources of income, together with any additional accounting adjustments. So, for example, your prepayments or your accruals. Taxpayers will still, however, be required to submit their final declaration by the 31st of January each year. There are some exemptions to mention in terms of MTD. These include trusts, estates, trustees of registered pension schemes and non-resident companies. And in addition to that, you've also got to include partnerships with a corporate partner and limited liability partnerships who are also not required to join MTD for income tax, but will, however, be required to join MTD at a future date. As Lisa mentioned earlier, those dates at the moment aren't final and are potentially subject to change. As with the existing MTD for VAT rules, taxpayers will need to use HMRC compliant software to make those regular submissions. With that in mind, it's important that those people who are affected by the new rules take action sooner rather than later so that they can ensure that the correct systems and procedures are in place. And we would therefore suggest speaking with a professional advisor who could potentially look at your circumstances and assess on a cost-benefit basis which would be the most appropriate system. For the majority of taxpayers, there's going to be most likely an off-the-shelf package that most people can kind of just subscribe to. But for some larger clients, potentially you might need something slightly more bespoke.
Thank you. Eddie, there's been plenty of speculation in recent years about a wealth tax. Do you think it could be something that the Chancellor decides to use if public finances don't recover quickly enough in the coming years?
Interesting question, Philippa. There's certainly been lots of talk about wealth tax over many years, and many experts and think tanks have come up with this as a solution or a suggestion. Research during the pandemic has indicated that those with existing wealth have tended to see overall value of their income and assets grow, whilst those with the least wealth have seen them decline. So maybe putting that into context, you can perhaps understand why this is a much talked about subject. Many do continue to argue that the richer members of society should be taxed on their wealth. I think as far as this government is concerned, though, it could be quite politically toxic because it would potentially target many of its own supporters. So the flip side of the coin, of course, is a government of a different nature may view this entirely differently. So my view is at the moment, we probably wouldn't see much, but potentially in years to come, it could be a very different scenario. Some of the world's wealthiest people, such as Bill Gates and Warren Buffett, have argued that millionaires and billionaires aren't taxed enough and that they should be paying more. Well, I think there'd be plenty of opportunity maybe for the likes of those to be paying more in future. One of the problems with increasing tax rates, and history tells us this, but when you try and increase tax rates, you often get more tax avoidance, ways of trying to find a solution to mitigate the increase in tax rate. So it can be somewhat counterproductive. Of course, those that are wealthier have the ability and the finances to plan their tax affairs in a way through tax planning, typically involving trusts and offshoring. So it doesn't always work to introduce an extra wealth tax. The government obviously needs to find some solution to this to discourage those kind of practices. But I think, like what I previously said about the national insurance and income tax realignment, I don't think this will be a big target for this particular government, but I think it may well be for a government in the future.
Thank you. Right, so from the last question on the slides, so I'm going to, after this, we'll pick up questions in the Q&A. So anybody that's got any questions building in their minds, this will be the last slide question, so please feel free to get those questions logged. What changes do we think we might see to the UK tax system in the longer term? So now we're talking about 5 to 10 years from now. Gavin, can I come to you first on that?
Of course, thank you, Philippa. So one area that is probably at the forefront of most people's mind at the moment is the environment, which itself is playing a greater role in the setting of policy in many areas. The impact of global warming is now being felt more regularly around the world. And we have seen, for example, in terms of financial reporting, the introduction of the Streamlined Energy and Carbon Reporting Initiative, whereby companies are required to, larger companies, I should add, are required to disclose their emissions in their financial statements. As a result, the government may seek to implement new green taxes that encourage businesses to act responsibly, perhaps something akin to the sugar tax on fizzy drinks or on low emission zones, or say the congestion charge in many cities. In addition to that, we've already seen this in the taxation of plastic bags. It is a very simple example, but this is likely to become much more widespread in the future. We've also already seen the government attempt to try and reduce this indirectly through allowing people to work from home and claim the work from home allowance on their tax return or even on the HMRC portal.
True. Eddie, what changes do you think we might see?
Well, as we've been discussing, Philippa, there is a big hole to fill here. So there will be undoubtedly a whole range of changes. If I were a betting person, I would definitely put some money behind a further change to pensions. We've got a little bit of history in recent times. There have been restrictions placed on the amounts that you can pay into your pension pot. There have also been restrictions on the tax relief. So I can only see some further changes there in the coming years, Philippa.
And Lisa, finally, what are your thoughts on any possible changes?
So I think similarly to what we've already discussed, I think the wealth gap widening, I think, is a major issue. So I think that there will, at some point in the next decade or so, there will be some sort of super tax for very high earners. I think that's probably one area that will go. And I think also properties is one area which is constantly looked at, and different taxes are brought in on different bits. I don't think we're going to go back to window tax style, but I think we might look at other sorts of taxes on properties, because for most people that is their single biggest asset that they've got. So that's the biggest value that the revenue could get taxed from.
Thank you for that. So that brings us to the end of the slide presentation. If I have a quick look now in the Q&A, let's have a look, see what questions have been put there. So Ian, I'm looking to buy a warehouse and fit it out. Will those costs qualify for the super deduction?
That's probably a me question, I think.
Lisa question.
Lisa?
So yes and no is the answer on that one. So with anything to do with properties, it will always be a combination of various tax reliefs are available and aren't available. So in terms of the actual acquisition of the property itself, properties don't qualify for tax relief themselves. At a later point in time, you would pay the capital gains on them, or you would get relief if there's a capital loss. You would go about it that way. So the bricks and mortar side of things, there wouldn't be any super deduction on those. However, the fit outside of it is where you would be able to obtain the relief. So if you are, if it's a warehouse and you need to do racking and you need the machines to move the items around the warehouse, all of those are likely to qualify. If, however, you need to put in air conditioning, for example, into the property, that would qualify for the super deduction, but that's at the special rate pool rate. So that's the 50% rate as opposed to the 150% rates. So it's a yes and no answer.
They're
Super straight answer in tax.
Yeah. Another question from the Q&A. So do you think the furlough scheme will be extended? Who should we take that?
I'll take that if I may.
Thanks, Eddie.
I think we have seen a number of extensions of the furlough scheme already. So on that basis, it would be no great surprise to see a further one. I think a lot really depends on what happens to all of us over the next couple of months and just how well we come back out of the situation that we've currently got ourselves into. One thing I think we've all learned from this pandemic is that there are no certainties over it and there are surprises all the time. So yeah, I wouldn't rule out an extension to it, but I think it will be based on the circumstances that we find ourselves in at that particular time.
Yeah, there's a few months to travel through yet, isn't there?
Indeed, yes, it's not a done deal by any means.
No. So I think that's all the questions that have been put in the chat bar. So I'll just keep a little eye on it, but I think that's it. So thank you to all of the panel for your fantastic insights during this session. Plenty of really, really useful information there. But if any of you who are watching would like to talk to a member of the team at Seymour Taylor about anything that's been covered today or any of the other services that they offer, then their details are on the screen. So just take a note of their number and their website. And from me, just a quick word to say, Buckinghamshire Business First. We might not have all the answers ourselves, but we do tend to act as a business's best friend in that we definitely know the names of the people who have got all the answers. So a really it can be quite lonely running a business, can't it? And there's absolutely nothing to lose and everything to gain in joining a business community like Buckinghamshire Business First. We're far stronger and have far more volume to our voice than when we speak separately as insular businesses. So thank you everyone for joining us for the hour that we've had for this session, and look forward to seeing you again at future webinars. So thank you. Bye.